Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates, 10-year note yields higher again. Go figure. We've had pretty much a sharp move higher in treasuries ever since we broke out of that 220 to 240 range, moved it to 230 to 260 to 260 to 280. Now we're above 280. Highest we've seen yield since January 2014, likely on our way to 3%. I know there have been a lot of calls out there that said 3% was coming. Well, it's almost here, and I think it'll probably be here sooner than we think. And if you look at where the market has come, we had some strong jobs reports. We had some positive news coming out of the president, the State of the Union. We've had equities on all-time highs, although not today. And I think that right now the market seeing that big reversal off the zero interest rate bound, the Federal Reserve that is trying to unwind its balance sheet while also raising rates. There's a lot of reasons why the market could sell off, but it's moved a very long distance in a very short amount of time. And I think that 3% will be a level that is very difficult to push through initially. So we may see a bounce. So right now we do still see some selling to the downside, yields going higher in the near term, but likewise not very much, at least until we get to that 3%. And then we'll need some kind of catalyst to see if we're going to get through it or if we're going to bounce back. And if you look at market volatility, it's telling you pretty much the same thing as we kind of go into this uncharted territory, a level we haven't seen in almost 4 years. The market is seeing higher volatility, which is actually very refreshing because the risks are continuing to rise. And I think we've all talked about the common sense risks. But I mean, if you look at now, it becomes even a bigger risk if rates go even higher, faster than I think that the market or the Fed expected. That could start to exaggerate on itself. So volatility is higher, and not just in treasuries. We're seeing higher volatility across the board. We saw it in the VIX today. We see it in some other areas. It's obvious just risks are rising, or at least are more evidenced. You're going to have to pay more for that insurance. And I think that's the best way to describe the volatility. And if you look ahead, a couple of key catalysts. We learned this week, obviously, the increasing size of the auctions. How is the government going to fund some of the things it wants to do? And how is it going to fund some of its deficits? Well, it's going to increase the auction sizes. And what that means is that the Treasury needs to find more buyers, especially if you take that one buyer who's been in there for the last 10 years, i.e. the Federal Reserve, out of the picture. So I think right now that is going to be one catalyst. The second is we're going to get a new Fed chair, and we get Jerome Powell taking the gavel on Monday, and I think that is something that's been sort of overlooked. Yes, we talked about it with Yellen's last Fed meeting, and we talked about it during his nomination process through the Senate. But I think that right now it becomes a reality, and what we don't really know about Jerome Powell is how is he going to manage Federal Reserve policy differently than, say, Yellen and Bernanke, who were very similar. So I think that right now, this is kind of another open-ended risk. And I think that when you see open-ended risk in the market, it leads to higher risk priced in higher volatility and priced in higher yields. And that could be one of the reasons why we're seeing the market act the way it is right now. Likewise, with the equity markets getting hit pretty hard on a Friday after a strong jobs number, after a number of different positive things that have happened, it could just be the market feeling it out. We're going to wait and see what happens when this new guy, considered to be one of the most powerful people in the world, the controller of U.S. monetary policy, hits the stage. And we really won't get to hear from Mr. Powell until he speaks to Congress. And that date has yet to be set, but it's likely going to be the third or fourth week of February when he does his semi-annual testimony for the Federal Reserve Chair. So right now, Treasury is still heading towards 3%. Volatility is higher. I don't see any reason why we would stop now, except for the fact that we do have a new Fed chair stepping in on Monday. So things may quiet down, at least for the near term, and not much data next week until we get into week 3 when the inflation numbers start coming down the pipe. This is Todd Colvin coming to you from the floor of the CME Group.